So the numbers that matter. So I'd like to start with a quick pulse check of like everybody's business, right? So everybody knows that sales is the pipeline, it's the lifeblood of your business, but sales alone doesn't guarantee that you're going to be making a profit. So if you find that you're selling more and more jobs, but you're still broke at the end of every month, that can be a sign that you may have an issue along the way. If your payroll every Friday is just feeling like a gamble, whether or not you're going to have enough cash in the bank account to make it, that can be an issue. If you have a whole bunch of busy crews, but no money left to pay yourself, that's again an issue. So the six KPIs that I like to look at or start with for any trades business are these. So we have net profit margin, gross profit margin, the labor efficiency or like revenue per truck, the overhead percentage, your break even point, or your accounts receivable, accounts payable days. So with these six, you can gauge whether or not you have an issue and then whether or not where that issue is within the business. And then you can dive in deeper to further understand, okay, these are the issues I have. How do we solve them? So net profit margin, aka the bottom line, this is going to be everybody's favorite number to talk about. It's the one that everybody likes to show other people. It's what's left after paying all of your expenses. So it's easy to calculate, right? You just go to your profit and loss, you scroll all the way to the bottom, you see that net profit number there. Well, if you divide that by your total revenue, your total sales, and you multiply by 100, that's your margin percentage. So the next KPI that I like to look at is going to be gross profit margin. So again, it's a really high level one. It's going to show how much of each sales dollar you keep after paying for labor, materials, and subcontractors. And it's easy to calculate. So you can go to your P&L, you can look at the gross profit, which the gross profit is going to be revenue minus your direct costs. If you take that number, divide it by your total revenue or sales, multiply it by 100, you get a nice percentage. Okay, so let's dive into the gross profit area just a little bit further. And that's where I like to look at the labor efficiency metric. You may have seen, like Grant Cardone and some other leaders out in the industry touting around some numbers around this, but one of the ways I like to do it is I like to look at the revenue generated per truck. So that's the revenue generated per truck. And I like to do truck because I know a lot of people like to run a lead tech with an apprentice, but I don't necessarily think that the apprentice is always generating a lead tech sort of revenue, right? So if we do it per truck, then we can calculate it as annual revenue divided by the number of trucks in the fleet, the number of trucks running around. Okay, so we kind of looked at cost of goods a bit. So now let's look at the flip side of that, and that's your overhead percentage. So the overhead percentage is going to show you how much of your revenue is consumed by non-direct costs. So that can be, your office and admin staff, rent and utilities, software, insurance, vehicles, advertising and marketing. So your overhead percentage is calculated as your total overhead expenses divided by the revenue times 100. That's just revenue times 100, convert it to a percentage. That way we can compare it across multiple industries. And then the next one. So the break even point. So this is the sales level where your revenue covers all your costs. So there's no profit, no loss. So the break even point shown in the graph here, right? As your revenue or sales goes up, you finally cross where your costs are. And that break even point is going to cover all your fixed costs, covers your variable costs. It means you're finally at the point where you're not making money, you're not losing money. And if you're beyond that break even, boom, that's where we want to be. That's where we start making profit. All right, getting to the last couple here. So accounts receivable, many of you are probably familiar with this one. So it's money owed to you by the customers for completed work. The accounts receivable days is how many days out basically is your last receivable. And then the flip side of that. So accounts payable days. So money that you owe vendors, suppliers, the subs. It's money that's outgoing from your business. And so just kind of expanding on that. So AR, AP, AR, we want to get the money in the business as fast as possible. AP, we want to try to keep the money in the business as long as possible. I want to wrap it up here a little bit. So putting all this together, why do I look at these numbers? Well, it's largely for this chart. So I want to understand, is the business healthy? If the business isn't perfectly healthy, why? And what region do we need to dive in deeper to? But hopefully you guys are all already looking at your numbers on a consistent basis and you understand that not understanding your numbers or looking at your numbers can lead to a lot of things, right? You could be underbidding jobs, again, that overhead creep, not making payroll, feeling that cash squeeze, you're super busy, but you're ultimately broke mentality, right? That's just general uncertainty.